Have you ever looked at two companies and just wondered what makes one of them truly great, while the other just kind of muddles along? Well, today we're going to break down a really powerful framework to help you spot those winners. If you want to invest with a bit more confidence, you are in the right place. Let's get right into it.
We have to start with this gem from Warren Buffett. It's so simple, but it's just profound. Time is this unstoppable force, right? For a genuinely wonderful business, time is like a massive tailwind, just pushing it forward. But for a mediocre one, it's a headwind, slowly but surely grinding it down. The real trick, of course, is figuring out how to tell which is which.
And that really is the million-dollar question, isn't it? How do you separate the future giants from the companies that are just treading water? Well, the answer starts with a really simple but totally crucial shift in how you think about it.
I want you to forget about watching the stock price blink up and down all day. That's a speculator's game. The real key, the secret sauce, is to think like an owner. Like you own the whole shebang, from the front desk to the loading dock. I'm telling you, adopting this one mindset changes absolutely everything.
Okay, so this brings us to our first big idea. It's all about framing your entire analysis around this concept of true 100% business ownership.
This right here, this is the ultimate test. You gotta ask yourself this question, because it forces you to look right past the day-to-day stock price noise and focus on what actually matters, the quality of the business itself. It's an owner's question, not a gambler's question.
So, how do we answer that big ownership question? Well, we have to become detectives. We're going to investigate 3 core pillars, 3 essential clues that are going to lead us straight to a wonderful business.
All right, our first clue is all about profitability. You can think of this as the engine of the business. It's what powers everything else: growth, innovation, dividends, you name it.
I love this old business proverb because it's so true. Huge sales numbers, revenue, that can look impressive, but it's really just vanity. It means nothing if the company isn't actually keeping any of that money as profit. That's sanity.
So how do we check for sanity? We look at margins. First up is gross margin. That tells us how efficiently they make their stuff. Then there's operating margin, which shows how well the day-to-day business is actually run. And finally, the big one, net margin. That's the bottom line, what's actually left over for you, the owner.
Now here's what's so cool about this. Margins, they tell a story. When you see consistently high margins, it's basically screaming that the company has a strong competitive advantage, some real pricing power. But when you see low or shrinking margins, that's a red flag. It could be signaling brutal competition or just inefficiency.
But beyond those margins, there's one metric that many of the world's best investors consider the absolute gold standard. It is the ultimate measure of a company's ability to create real, long-term value.
And that metric is return on invested capital, or ROIC. It basically answers the question, for every dollar we put into this business, how much profit does it spit back out? A business that can consistently earn a high return here is just a powerful wealth compounding machine.
Okay, so our company looks profitable on paper. We're feeling good. But that's not enough. For our second clue, we have to follow the real money. We have to ask that critical question, are those profits actually turning into cold, hard, usable cash?
This is such a powerful idea to grasp. Because of all the rules and flexibility in accounting, that profit number you see on the income statement, it can be, well, let's just say it's an opinion. It's not always the full story.
But cash? Oh, cash is a fact. Money in the bank is undeniable. You can't fudge it with accounting tricks. Cash flow is the ultimate truth teller when it comes to a company's real financial health.
And that leads us to the most important number here, free cash flow. The easiest way to think about it is like the company's take-home pay. After all the bills are paid and all the necessary investments are made to keep the lights on, this is the real cash left over. This is the good stuff. It's the money that pays for dividends, paying down debt, or funding new growth. It really is the lifeblood of the business.
And this slide just illustrates the point perfectly. Look at this. Company A and Company B. They both report the exact same net income, $100 million. They look identical on the surface. But then you look at their free cash flow, and wow, Company A is a cash machine, generating $100 million in real cash. Company B? It's only making $10 million. Now, which one would you rather own? It's not even a close call.
So this brings us to our third and final clue, the strength test. A business can be profitable and cash-rich, but But if its financial foundation is wobbly, it's vulnerable. We need to know if this thing is built on solid rock or on shifting sand.
The tool we use for this is called the balance sheet, and it's all based on this simple but really powerful equation. Just think of it like a financial snapshot. At one specific moment in time, it shows what a company owns, what it owes, and what's actually left over for the owners.
And we can use a few quick safety checks to see how strong that foundation is. First, debt to equity. This just shows how much the company is relying on borrowed money. Too much debt can be really risky. Then, the current ratio tells us if they have enough cash handy to pay their immediate bills. And finally, interest coverage shows if they're earning enough profit to easily make their loan payments. You put these together and you get a really clear picture of financial resilience.
So let's recap. We've checked for profits, we've followed the cash, and we've tested for strength. Now let's look at one of the most tangible rewards of all this quality. For a lot of us, a strong, reliable dividend is the ultimate proof that we found a wonderful business.
But listen, when you see a company with a high dividend yield, don't just jump in. You've got to dig a little deeper. Is the payout ratio sustainable, or are they paying out too much? Do they have a long history of growing it? And here's the most important question. Is that dividend being paid from real, actual free cash flow, or is the company borrowing money just to make the payment?
Here's a pretty good rule of thumb for you. A payout ratio somewhere in that 40 to 60% range is often a sweet spot. It shows the company is serious about rewarding shareholders, but it's also keeping enough cash in the bank to reinvest for future growth. It's a sign of a healthy balance.
And all of this brings us right back to where we started. After you've looked at the profits, followed the cash, checked the balance sheet, and inspected the dividend, you can finally answer that fundamental ownership question. So I want you to take a look at your own portfolio and really ask yourself, are these investments businesses that you would be proud to own 100%?